You know exactly what this feels like. You're sitting in yet another Friday afternoon strategy meeting, just sort of staring blankly at a spreadsheet on your screen.
Oh, yeah, the classic corporate glaze over.
Exactly. And this really uncomfortable realization washes over you. You realize you are building immense wealth, but you are building it entirely for someone else.
Right, you've got the resume, you've got the skills, and you're actively dreaming of leaving that whole 9 to 5 grind behind to finally become a business owner.
Or, maybe you're already an investor and you're currently out there hunting for your next major strategic move in the franchise space. But, and here's the ultimate franchise buyer's dilemma, you run into this wall almost immediately.
You want a business that makes serious, aggressive money, but you also want to, well, actually feel good about what you do.
Yes, you don't just want to open another fast food joint, manage a drive-through, and spend your days worrying about the deep fryer.
Right, it's that classic tension between financial ambition and personal fulfillment. Because most investors assume you have to sacrifice one to get the other.
Totally.
The conventional wisdom is that you either go into a highly lucrative, heavily commoditized, cutthroat industry, or you start a passion project that makes you feel warm and fuzzy, but barely keeps the lights on. It is incredibly rare to find a model that successfully marries the two.
It's honestly like dating. I mean, you're out there looking for the unicorn. You want the one with a good heart and a really solid financial future.
Yeah, but most of the time you feel like you have to choose between running a charity and running a pure cash grab.
Exactly. You want the high profit margins, but you also want to look in the mirror at the end of the day and know your business actually helped someone in a very tangible way.
Which is exactly why we're looking at today's topic.
Right. So our mission for this deep dive is to explore a really fascinating opportunity sitting right in the middle of the massive $8 billion home service industry. It's a franchise brand called Mobility City.
And Mobility City sits exactly at that intersection you just described.
Today, we are going to completely unpack this specific franchise model. We'll look at its unit economics, the psychology of the buyers it attracts, and, why its totally unique operational setup is catching the eye of both multi-unit investors and corporate professionals.
Because what we are really examining today isn't just a basic catalog of what this brand sells. I mean, that's just the surface.
Right.
This deep dive is about understanding how the business model itself is structurally designed to create wealth while simultaneously providing a deeply meaningful, almost critical service to the community.
It's really cool. So before we start throwing around financial returns and investment ranges and talk about, building a multi-unit empire, we first need to understand the product and the actual market demand.
Absolutely, because a business only scales if it solves a real problem.
Let's be real as investors. If it doesn't solve a pressing problem, it's just a hobby. So what is the core offering here? At its foundation, Mobility City is a people-first business. They sell, they rent, and they repair mobility equipment.
Right, so we are talking about wheelchairs, power scooters, recliner lift chairs, hospital beds, and stair lifts.
Their stated goal is to restore independence for seniors, the disabled, and veterans. And I should note, actually, they are a proud VA-contracted provider.
Which is huge.
It is. It means they work directly with VA case managers to service equipment covered by veterans' benefits.
And that's an incredibly vital service. When we analyze this specific market, we really have to understand that we aren't talking about luxury goods, right?
No, not at all.
We aren't talking about discretionary spending. We are talking about fundamental human quality of life. For a senior citizen or a disabled veteran, a broken power chair isn't just an inconvenience. It's not like a broken dishwasher.
It is a total loss of independence.
Exactly. They are quite literally trapped in their homes or even in a single room. Because of that severity, the demand here is what economists call highly inelastic.
Okay, let's ground that term for a second. Inelastic demand essentially means that, well, the consumer's need for the product doesn't change even if the economy goes sideways, right?
Right.
Like if the stock market crashes or inflation spikes, you might cancel your family vacation to the Bahamas. But if your grandmother's stair lift breaks and she physically cannot get to her bedroom safely.
You are paying to fix that stair lift that afternoon.
Exactly. Regardless of what the S&P 500 is doing.
That is the perfect way to frame it. The need does not fluctuate with the stock market or seasonal consumer trends. Furthermore, when you look at the demographic data, the aging population, the so-called silver tsunami, is growing exponentially.
Yeah, the numbers on that are staggering.
So the baseline need for this specific type of physical support is expanding rapidly year over year.
I completely agree with the social value and the demographic trends. Helping people, especially veterans and seniors, regain their mobility is incredibly noble.
It is.
But I have to play the role of the skeptical investor here a second.
Please do.
Because anyone, and I mean anyone looking at the healthcare space or the senior care space, immediately thinks of one specific nightmare, and that's red tape.
Oh, the bureaucracy.
Yes. You think of endless insurance claims, you think of navigating complex Medicare billing codes, getting denied on some ridiculous technicality.
Right, and waiting 3, 6, or even 9 months just to get a check from the government for a service you already provided.
Isn't that a massive, overwhelming headache for a new business owner? Especially someone transitioning out of the corporate world specifically to escape bureaucracy.
Well, what's fascinating here is that the franchisor recognized that exact same friction point. They knew that traditional medical billing is a massive deterrent for savvy investors.
But what do they do?
They engineered the business model specifically to avoid it. Here's the brilliant strategic pivot that defines the entire franchise. Mobility City does not accept Medicare.
Wait, hold on. A mobility equipment company that services seniors but doesn't take Medicare.
That's right.
Isn't that instantly pricing out a massive portion of the demographic who are living on fixed incomes? I mean, how does a cash-only model survive if your core customer base is notoriously price-sensitive?
It sounds counterintuitive at first, I know. But let's break down the why behind it, because it is literally the linchpin of their financial success. Yes, it is entirely a cash-driven business.
Okay, I'm listening.
Now, put yourself in the shoes of a family whose grandfather just had his power wheelchair breakdown. If they go through Medicare, they have to get a doctor's prescription, submit it to the government, wait for approval, and sometimes wait weeks or months for a designated repair person to finally show up.
And the grandfather is immobilized that entire time.
Exactly. The pain of waiting is far worse than the financial cost of the repair.
Ah, I see. So the value proposition isn't just the repair itself. The value proposition is speed.
Precisely. Families will happily pool their money, pay out of pocket with a credit card or cash to get that chair fixed in 24 hours rather than wait 2 months for the government bureaucracy to move.
Wow. Yeah, that makes total sense when you frame it that way.
And by intentionally removing Medicare and traditional insurance hurdles from the business equation, the franchisee gets paid directly and quickly. The financial profile of this model highlights that it, quote, throws off lots of cash.
Because when you bypass the insurance bureaucracy, you eliminate the massive back-office administrative burden.
Exactly. So you aren't hiring a dedicated team of billing specialists whose only job is to sit on hold with the Centers for Medicare and Medicaid Services all day, trying to chase down nickels and dimes.
You don't have accounts receivable sitting out there for 90 or 120 days, just tying up all your working capital.
Nope. A customer has an immediate pressing need. They pay for the repair, the rental, or the new scooter, and the business realizes that revenue instantly.
Which is huge.
It is. And this is why corporate professionals are so drawn to this model. They want the personal fulfillment of the healthcare sector, but they absolutely do not want the administrative nightmare of the medical industry. It keeps the business incredibly agile and cash flow positive.
Okay, let's unpack this. Because if I'm bypassing the government wait times, the strong cash flow suddenly makes total sense. But I'm still trying to picture what this actually looks like in practice.
What do you mean?
Well, if your customer physically struggles to move, how does a retail model work? Like if they have a broken 200-pound power wheelchair, they can't exactly load it into the trunk of a Honda Civic and drive it down to your strip mall location.
No, they certainly can't.
So how exactly does the day-to-day operation function to actually reach these people?
That is the exact logistical hurdle that destroys traditional medical supply stores. And it's why Mobility City operates on a really clever hybrid operational model.
Okay, hybrid how?
Well, when you open a franchise, you do open a physical local showroom. It's a modest footprint, but it's an essential space where people can come in, look at the equipment, test drive a power scooter, or, figure out how a recliner lift chair actually feels before they buy it.
Okay, people want to test that stuff out.
Exactly. But, to your point, the showroom is only half the equation. The real magic and the true revenue driver of their service model is what they call the workshop on wheels.
Workshop on wheels. Okay, I love that concept.
It's brilliant. It's essentially a fleet of customized vans driven by highly trained, background-checked, certified technicians.
So they go to the customer.
Yes. Instead of forcing an immobilized customer to somehow drag heavy, broken equipment into a store, the technician makes a house call. They bring the repair shop directly to the customer's living room.
Oh, wow.
They diagnose the issue, swap out the battery, fix the joystick, and get the person moving again right there in their own home.
That makes so much sense. It's essentially the ghost kitchen model applied to medical devices.
Yes, that's a great comparison.
You have a relatively lean physical storefront to anchor the brand, but your delivery radius, your fleet of vans, allows you to capture the revenue of a massive geographic area.
Exactly. You aren't just sitting passively in a retail shop waiting for foot traffic to wander in. Your business actively goes out into the community to hunt for revenue and provide service exactly where the customer is most comfortable.
And if we connect this to the bigger picture, think about what this mobile approach means for the franchisee's labor pool. Because of this hybrid model, you aren't managing a massive, sprawling retail operation with, like, really long operating hours.
Right. You don't have 50 minimum wage teenagers on the payroll that you have to constantly schedule, supervise, and replace when they quit.
Which is the reality for so many food franchises.
Exactly. A Mobility City franchise typically starts with just 3 employees and eventually grows to a staff of maybe 5.
Wait, I really want to pause and highlight that. Just 3 to 5 employees.
Yep, just 3 to 5.
If I only need 3 to 5 highly trained technicians, I am essentially immune to the current fast food and retail labor shortages.
And that is the aha moment for most buyers looking at this brand. These aren't transient workers. These are dedicated, certified technicians who view this as a stable career.
They are out in the field representing your brand.
Exactly. And this incredibly lean headcount is exactly what appeals to corporate professionals leaving their high-stress jobs. Think about the lifestyle difference.
It's massive. A highly manageable payroll, drastically fewer HR headaches, lower turnover, and a small, tight-knit team of professionals.
It means the franchise owner can actually function as an owner. You can focus your time on growing the business, networking with local VA hospitals, building referral relationships with physical therapists.
Rather than just constantly putting out internal staffing fires because someone didn't show up for their shift. That has to be a huge relief for someone stepping into business ownership for the first time. I mean, the sheer terror of managing a giant, unpredictable staff keeps so many smart, capable people just sitting on the sidelines.
Oh, completely.
But look, a lean staff, an inelastic market, and a cash-based model sound fantastic in theory. But if my headcount is that low, and my real estate footprint is essentially just a modest showroom and some parking for vans, my overhead has to be a fraction of a standard franchise.
It is.
So how drastically does that lower the initial buy-in for an owner? Let's talk unit economics.
Yeah, the financials are really where the operational efficiency translates into investor value. So let's break down the investment profile. The initial investment range to open a Mobility City franchise falls between $232,250 and $513,500.
Okay, so roughly $250,000 to just over $500,000. But why is there such a massive variance there? I mean, a nearly $300,000 swing in the initial investment range is pretty significant. What drives that difference?
Well, the variance mostly comes down to your local commercial real estate market and your aggressive day one strategy.
Gotcha.
The lower end of that spectrum assumes a more modest lease for your showroom in a reasonably priced market, and perhaps launching with just one fully outfitted van.
And the higher end?
The higher end of that $513,000 range accounts for securing premium retail space in a higher cost market, extensive leasehold improvements, and launching right out of the gate with 2 or 3 fully stocked vans to capture market share immediately.
Makes sense. And what does it take to actually qualify financially?
To qualify for either end of that spectrum, the franchisor requires a prospective owner to have a net worth of $1 million and at least $250,000 in liquid cash.
That's a fairly standard barrier to entry for a serious, highly supported franchise brand. It shows they want well-capitalized owners who aren't going to be sweating the electric bill in month 2.
Right. They want people who can afford to market the business and scale it properly.
What about the ongoing fees?
The structure is very straightforward and standard for the industry. There is a 7% royalty fee on gross sales and a 1% ad fund fee used for national brand marketing.
Okay, pretty standard. And how long is the agreement?
This is based on a standard 10-year franchise agreement, which is renewable in 5-year increments. And very importantly, tying back to their strong operational relationship with the VA, they do offer significant veteran discounts on the initial franchise fees for those who have served.
I love seeing that alignment. I mean, if you are going to serve veterans as a core part of your revenue model, you should absolutely be incentivizing veterans to own the business.
Absolutely.
Now, what about the track record? Because no investor, no matter how much they love the mission, wants to be the guinea pig for an unproven concept.
Oh, the concept is well past the experimental phase. They've been proven over 6 years, having started franchising back in 2017.
Okay, so a solid runway.
Yeah. Based on the data we were looking at, they have around 48 units currently operating nationwide, with another 14 signed but not open yet. So that's 62 territories sold. Wow, okay.
And they are on a very deliberate, strategic march toward a cap of 200 territories. They don't want to oversaturate the market. They want 200 highly profitable territories.
And here's where the math gets really interesting. The brand documentation mentions a targeted potential of hitting seven-figure revenue with a 20% bottom line margin.
Yes, that's the target.
When you look at that 20% bottom line target, how does this specific investment range, that 200K to 500K mark, correlate to the overall risk profile for a first-time franchise buyer? Like, why is this attractive compared to other options?
That is probably the most critical question an investor can ask. In the franchise advisory industry, that 200K to 500K entry point is widely considered the absolute sweet spot for mid-level corporate professionals and multi-unit developers.
The sweet spot, why is that?
Well, it is low enough that it doesn't require raising complex institutional capital or taking on crippling debt, but it is high enough to weed out the hobbyists who aren't serious about scaling a business.
Right, you get serious players. Exactly. And the risk is heavily mitigated by the exact mechanisms we discussed earlier, the lean operating model. Because your overhead is essentially a modest showroom, a couple of vans, and just 3 to 5 employees, your break-even point is incredibly achievable.
Compare that to like a massive 5,000 square foot restaurant build-out where you have to sell thousands of $5 burgers just to cover your 60 employees and massive utility bills.
Exactly. It's a completely different risk profile.
Right, so you have a vastly lower fixed cost burden combined with a high margin cash pay service. And because you only need 3 to 5 employees per unit, suddenly the idea of buying 3, 4, or even 5 territories doesn't seem like a logistical nightmare.
No, not
If I buy 3 territories, I essentially own an entire region, but my total employee headcount is maybe 12 or 15 people.
And this raises an important point about multi-unit strategy, which really is the dream for sophisticated investors. The low employee count and strong margins make it highly attractive to buy multiple territories at once.
Because it's actually manageable.
Yes. And because they are currently at 62 territories sold, marching toward that 200-unit cap, there is a massive window of opportunity right now.
That window won't stay open forever.
No. There are still wide-open territories available in major metropolitan markets. You can secure a massive geographic footprint, dominate a region with a fleet of your mobile workshops, and establish complete market dominance before the brand hits its cap and the door closes entirely.
You are building a legitimate regional empire, but your operational headaches remain incredibly small.
That's the beauty of it.
That is incredible. So to bring this all together, we are looking at a brand that has figured out how to completely sidestep the traditional bureaucratic nightmares of the medical supply industry.
They really have.
Mobility City is that incredibly rare hybrid. It is a deeply purpose-driven, community-serving business that actually makes a tangible, emotional difference in people's lives, especially for seniors and veterans who are desperate to maintain their independence.
And beneath that noble mission, it possesses the aggressive, cash-flowing, low-headcount unit economics that savvy, corporate-trained investors demand.
It's the unicorn.
It truly is. You are providing top-tier repair, rental, and sales of crucial, life-changing equipment. You are utilizing a brilliant, highly efficient workshop on wheels model to meet the customer exactly where they are.
Right.
And you are doing all of this while operating a high-margin, strictly cash-based system that keeps your back office incredibly clean, simple, and profitable.
So what does this all mean for you, the listener? If you are that corporate professional looking for the exit ramp out of the Friday afternoon strategy meetings, or you are the multi-unit investor looking to diversify your portfolio into a recession-resistant, demographic-driven market, this is a business model that demands your attention.
And I want to leave you with a final provocative thought to really mull over as you analyze this space.
Let's hear it.
Look around your own community right now. Think about your neighborhood, your town, your city. When an elderly neighbor's power chair suddenly breaks down on a Sunday morning, or a local veteran needs a stair lift repaired immediately so they can safely get to their bedroom, who do they call right now?
That's a great question.
What is the actual immediate solution in your town today? Consider the immense, virtually untouchable competitive moat you build when you own the business that solves an immediate, highly emotional, and deeply physical crisis for families in your own community. You aren't just selling a retail product, you are restoring human dignity on a daily basis. And that is an incredibly powerful, incredibly profitable foundation for a business.